Hello everyone, this is Dr. Narayan. Today I'll be telling about volatility and how to handle it for option trading. I hope you have liked the previous video on Gotch modeling where I have told about modeling volatility. Today we'll be dealing with the practical aspects of option trading using volatility and how to use the data for option trading. So let me share my screen. Okay, so today's topic is handling volatility in option trading. So as you are aware from the previous video that we have implied volatility, realized volatility and historic volatility. Implied volatility is nothing but market's expectation of the future price and movement of an asset or a stock. It may be a stock, it may be index or whatever it is. It is the market expectation of the future price. Realized volatility is the actual volatility which has been realized. And you have the historic volatility. So that is basically the volatility that has existed in the past for a given period of time. Maybe you can take 6 months data, 1 year data, 2 year data, or whatever it may be. So understanding these terminologies, implied volatility, realized volatility, historic volatility, is very important for an option trader and to take trade based on these data and interpretations based on them. So how to trade options using volatility? Understanding volatility of individual strike price is very crucial. Please remember, at the money strike options have a given implied volatility, and as you go away or the far out of the money options have very high implied volatility, or generally volatility increases for out of the money options. So there can be sudden spike or decrease in the volatility, which may lead to sudden spike in the option strike price or sudden drop. So the option trader must be aware. So you should be very well aware when you're dealing with out of the money strike options, especially deep out of the money. Usually volatility spikes before quarterly results. Volatility has a mean reversion principle. That means it will not continuously increase or decrease. It has a tendency to come back to its mean after a given period of time. Usually the value implied volatility minus realized volatility is a positive number. The increasing value of the graph, that is the implied volatility minus realized volatility, is advantageous if you are an option seller, whereas a decreased implied volatility minus realized volatility is advantageous if you are an option buyer and disadvantageous if you are an option seller. We'll try to understand with some charts. Some of the points you should consider before deep diving into option trading is always avoid speculation and tips. Trade should be based on data and technical charts. Option is one of the most complex financial instruments which is not fully understood. At least basic knowledge of the option Greeks, open interest and volume is must before trading. Risk management and position sizing is extremely important. Be aware of the worst case scenario and how to deal with it. Option trading can be emotionally taxing. Having appropriate knowledge and taking trades according to one's financial capability is very important. Never do over trading. So you should know basic knowledge of option Greeks, basic knowledge of technical charts, open interest volume correlation between them. Be familiar with some of the F&O terminologies such as long build-up, short build-up, long unwinding, short covering. We already talked about impact of implied volatility. Also remember, when you are dealing with stock options, it leads to physical delivery. Please square off the positions and never wait till the expiry day. Losses are inevitable. You should know how to accept, learn and move forward. Invest time to understand markets. I suggest to use hedged positions when dealing with highly volatile stocks. Use data for trading and use web pages such as Opstra and Sensible, which gives you this option data. So I'll be just showing you an Opstra tool and how to use them for your trading. So this is how an Opstra tool will look like. This is your home page. You can create an account. I have a paid account. Even in the free account, you have so many options in Opstra. Just go to options. I'll be telling you how to read the intrinsic volatility charts. Just go to options, click on option dashboard. So you'll get a table like this where you have the results column. If you are expecting a results, it will be highlighted in green. You have the liquidity in this particular script. Then you have the ticker, what is the script name, price, change in the price. You have the straddle, then the call IV price, put IV price, and the general IV price. Then the IV change compared to the last day. Then you have the IVR and the IVP, that is the intrinsic volatility rank and intrinsic volatility percentile. Intrinsic volatility percentile generally refers to how much in the previous year this kind of volatility has been seen. So in Nifty, if you see, it is a very low IVP. So generally throughout the year, we have seen a very high volatility. Now it is very low volatility. Even trading a very low volatility script is quite challenging, and very high volatility script comes with its own challenges. So let me check some of the IV charts in order to explain to you. Suppose I click on Adani Enterprise. This is your price movement. You can see there's a flat price movement right now. And if you have seen, the realized volatility is much lower than the implied volatility. That is why your IV minus RV spread is a positive number. That means the implied volatility, the price which you are paying for an option premium, is quite high. So please be aware of it. So IV minus RV spread is a positive number. So if you're an option buyer, you should be very careful with this kind of plotting. So this is your implied volatility, historical volatility, 30-day historical volatility, 10-day historical volatility, and IV minus RV. So if you see here, even the implied volatility, it is never a constant number. It keeps on changing. So let me show you another stock, ACC. This is your IV, implied volatility percentile. This is your implied volatility. So I'll just unselect everything and show only the IV. So if you can see, it goes up, comes down, goes up, comes down, goes up, comes down. Since there's a spike here, this is more pronounced, and your IV and RV spread will accordingly act. So if you see here, the IV RV spread has always been a positive number, whereas in certain scripts you can have momentarily IV and the RV's value less. Suppose we take Maruti, where the results are expected right now. You can see the IV minus RV has been continuously decreasing because the IV has been increasing. So if I just unselect everything and only the IV, you can see the IV has been continuously increasing, and IV minus RV has been reducing. So we can expect IV to come back to its mean position and the IV RV value to go up after the results. So this is the prediction. So like this, for an option trader, you have to understand these implications before taking a trade. That is what is I want to tell before I conclude this particular session of my talk. This is Dr. Narayan, doctorate from Indian Institute of Science, Bangalore, and MBA from IIM Kashipur, signing off. Take care of yourself. Please subscribe to the channel. I hope you found this video interesting. Thank you very much.